And this afternoon I have Amit Bahri with me from Goldman Sachs Asset Management, who is co-head of European Direct Lending. Amit, thank you so much for joining us today.
Thank you for having me, Kate.
So let's get straight into it. Amit, there's been huge growth across the European direct lending market in recent years. How are you seeing that growth and how are you thinking about that shift?
Yeah, it's a good question, Kate. So, we've seen a sort of a fascinating journey for private lending, for direct lending in Europe over the last 15 years. If you look back, 5-6 years and then, going back to the GFC, a lot of the companies that were accessing the direct markets or the direct lending markets were smaller mid-cap companies. We've been in the market on the senior direct lending side since '08, and our first fund was 10 billion. So we've been looking at large companies from the beginning of our strategy. But I would say for the first many years of our strategy, most of what we were competing against, or the alternative source of funding for these companies, was the syndicated or the capital markets. What sort of shifted in the last 5-6 years is that you've seen increasingly larger and larger companies that could access the capital markets go down the direct lending route. Now, why is that? I think the reason for that is manifold. And this, by the way, I'm talking before the current market dislocation, which I'll come to in a minute. But essentially, it's a more customized solution. It's something you directly negotiate with the end investor rather than going through intermediaries. It can offer you a compelling certain execution. And candidly, I think a lot of borrowers, private equity funds, management teams quite enjoy having a direct lending relationship and working with the direct investor. So over the last few years, the scale of companies that are accessing this market has become much larger, where now I would say there is no sort of upper bound on this company is too big to go down the direct market and will go into the syndicated market. Last year we saw Unitranche for Business, which had 300 million pounds of EBITDA. And this was all before the market dislocation. And then obviously the market dislocated in the summer last year, and we've seen still a decent amount of LBO activity in Q4 last year, and all of that was financed with the direct lending market. But I think that the important point which I'm trying to make is that this sort of shift for more and more companies to access the direct lending markets was a structural shift over the last 10-15 years, and that's sort of gotten accelerated with the current market volatility. Now that market volatility might go away after a while and we'll see some sort of a normalization, but we're really seeing this sort of source of financing becoming front in mind for borrowers, for investors, and for the whole LBO ecosystem in Europe and in the US.
Now you talk about the ecosystem. How are you thinking about the dynamic with other players?
Yeah, look, I think as this market scales and evolves, I think other players entering the market, and some level of competition is only healthy for the market, because if you go back 10-15 years ago, it was really the syndicated market we were competing against, as one of the largest scaled European direct lenders. Now that's shifted over the last few years, but the important point is that the overall penetration in the direct lending market versus the broader syndicated market, I think that is going to outgrow the competition within the direct lending market. And actually having multiple sources of financing, having multiple players who are offering direct lending as a solution to borrowers, I think is only making this a more front in mind product for borrowers. And so I think it hasn't gotten to a point where it's too competitive. I think we're still in this sort of journey where this market is going to scale and evolve. I still think we're sort of in the early parts of that journey. And candidly, at this moment in time, the biggest competition we all had, which is the capital markets, is shut. That will obviously come back over time. But as I was saying earlier, using direct lending is not just a phenomena that we've seen in tough markets. In markets which are very functional, companies of large scale, high quality companies were still using this market. So I think it's going to continue to grow.
So if we take a focus on specific market conditions, how has that impacted appetite and acceptance of direct lending?
Yeah, so I think 3 parts to that answer. So the first is deal flow is still there. What we saw in 08-09 was there was an 18-month period where there were no LBOs in Europe. That's not the case now. In Q4 alone, we saw a lot of LBOs. We did 6-7 new direct lending deals. Sponsors have dry powder. They want to deploy it. And buyers or sellers are agreeing on prices for high quality assets. So that's first. Secondly, returns have edged up substantially. part of that is just the fact that base rates have moved up to a more normalized level. I wouldn't say elevated, I would say just normalized level, where interest rates should be over a long period of time, versus sort of the 14 years before where rates were zero. On top of that, you've had spread widening. And so, we're seeing, the all-in yield being 400 to 500 basis points more than it was last year this time. And again, a big chunk of that is just coming through the base rate. So I think that should stick. Spreads will come in potentially depending on what happens to the syndicated markets. But overall, I think the kind of yields we're seeing is much better than what we've seen for the last decade plus in the direct lending market. And then the third bit, which is important, is capital structures are more prudent now. Leverage multiples have come down, as they should. And the reason for that is very simple, which is the cash interest burden on companies has gone up substantially given what's happened to the base rate and what's happened to spread. And we've seen leverage multiples, sort of adjust for that. So from my standpoint, I think the risk-adjusted return for investing in this asset class, looks better than it has for the last, many years.
And to continue the conversation and focus on risk, how should market players be thinking about risk?
I think it comes back to a prudent credit underwrite. For the last 15 years, every time I've looked at a deal, our starting assumption is next year there's going to be a big recession, and how is this credit going to perform in that environment? It just so happens that now that's probably going to happen because this is the most talked about recession in a while, where everybody's expecting a recession. So I think it comes down to credit underwriting. It comes down to picking sectors which are resilient. It comes down to, within those sectors, picking scaled market leaders, backing some of the best private equity buyers, and making sure that cash flows are work even in a stress situation. Because I think one of the key focus areas as we go through this normalization of interest rates is how will companies cope with the higher cash interest burden. So I think so long as the underwriting investing philosophy is prudent and is focused on these sort of resilient market leader players in some of the biggest buyouts in Europe, I think that should be a good recipe for navigating what will be definitely a potentially tough macro environment.
And finally, Amit, what is your outlook for 2023?
So I think, outlook, I think deal flow will pick up. So first of all, from a deal flow standpoint, I think it's probably going to be slow in Q1. I think we'll pick up deal flow in Q2, Q3, invariably, as the macro situation eases. And I think, certainly the mood music on the macro side, inflation, recession is a lot more positive than it was, candidly, a month ago. So as that sort of hopefully continues to normalize, and as more and more companies transact, that should build confidence for there to be more deal flow. It's impossible to predict where the capital markets will be and when will the syndicated markets come back, which invariably it will. And so I think overall the environment should be good. Are there some tail risks out there which we can't foresee, whether that's a worsening situation in the geopolitical side, whether that's another energy price shock, impossible to predict. But it does feel like, when we speak to our management teams, it does feel like everybody has geared up, expecting the worst, both on the, revenue side and on the cost side. And so, hopefully there should be some surprise to the upside.
Let's hope so. Thank you so much, Amit.
Thank you.